What is going on, everybody? My name is Reda, and man, have I been waiting to make this video for a long time, right? The stock market is a very volatile place to leave your money, right? But opportunities come up every couple decades, right? Every couple years that just will never come about again. And times like this are times where if you capitalize correctly and you do the correct things, you are going to leave wealthier than you started off with, right? And let's talk about it, right? This is the S&P 500 ETF, SPY. It's incredibly popular. Most of you probably know exactly what I'm talking about, right? Let's go to this drawing set, and I want you to notice where we were just a couple of weeks ago, right? Almost a month ago, just a little bit less than a month ago, we were at 340 on SPY. We are currently at 248, okay? We are currently at 248. Mind you, let's do the math on that, right? Let's do the math. Let's have some fun. Let's see if I can make this calculator bigger. I guess not, right? 340, right? Minus 248. 248 is going to give us 92 points down, right? 92 divided by 340, we have dropped 27%. Let's put that into perspective. The S&P 500 year-on-year average, right, equals just about 8%. Okay? We have moved down, okay, in the last couple weeks, last about 3.5 weeks, down 27%. Mind you, we did have a crazy year last year in terms of gain, right? We did shoot straight up, but putting that aside, we are down 27%. Okay, we are down 27%. That means if we take 27 and divide it by 8, right? We have moved the equivalent of 3.5 years. I mean, obviously, right, in terms of average, right? We're talking about average. We're not going to talk about in respect to the year that we had before. None of that, right? I'm going to talk simply about the S&P 500 and how we can tell you almost for certain, right? Almost for certain, margin of safety, the intelligent investor, anybody, Benjamin Graham, Warren Buffett, Seth Klarman, any value investor, is going to tell you that as we decline is where most of the opportunities begin to present themselves, right? So enough jibber jabber, right? Let's talk about what people are doing, what people are buying, what people are doing with this dump. Well, you could just say, hey, I'm going to just start buying right now. But you don't know if this is it, if we're over right here, because we could continue to drop. So the fear becomes, am I buying at the right time? Right? Warren Buffett is famously quoted as saying, if you've got a ton of money, right, we have these beautiful things called ETFs. If you've got a ton of money and you divide your money into maybe 10 and you buy slowly over 10 years, right, so you buy one lot over 10 years, you might have some good entries, some bad entries, but overall, you're going to be completely fine, right? This same idea applies in a very volatile downward market, right? So if we've got, for example, let's do it based on this, right? If we've got 25 million, which is probably most of us don't. If we have 25 million versus 25,000, okay? How can we grow, assuming that we just want to beat the 8% per year average? We just want to make more than 8%, okay? That is our idea. We have 25 million and 25,000, right? The biggest idea here is you want to pick stocks that we think were trailing the market prior to this dump and then now are somewhat overreacting a little bit, right? They're moving lower than we think they should be moving, right? And overreaction is a big word, right? Because if we think the entire market's overreacting, then the idea becomes, is the coronavirus play an overreaction just in general, right? But we're not going to talk about that. We're not going to jump into specifics. We're going to talk about pure sound logic. Here are the two stocks we're going to talk about today. Disney. Here's the 3-year weekly chart on Disney. You can notice in the last 3 years, Disney has never been as low as it is today. Now, of course, after hours today, Disney did close one of their parks, right? Their park in California, Disneyland in California, did close. And this means that probably going to continue maybe to go down. But it doesn't matter, okay? It doesn't matter if we continue to go down because Disney was at $150. We've had a $50 per share drop on Disney, or $60 per share drop. If we moved back up just half of that, that would be a 33% move. We would already beat the market average. If we moved back just half of what we dropped, if we gained back just $30, we went from 90 to 120. We are making a 33% move, which is already higher than the average, even higher than how much we've dumped, right? So the first stock on my list here is Disney. Right, so let's do this. So we have 25 million and we have 25,000. Okay, let's go down to the middle here and we're going to put Disney. That's the first stock we want to watch, okay? The first stock we're watching here is Disney. And why? Well, because we think that there's an overreaction. We see value that we don't think the market is seeing, right? This is the idea behind value investing. Disney is the first one. The next one, Caterpillar. Caterpillar is a market staple. It's a Dow Jones major component, right? And if you take a look here, ladies and gentlemen, Caterpillar on the 3-year weekly chart is almost lower than it's ever been. In fact, today during trading sessions, it did get lower than it's ever been. It hit 87.50, right? Caterpillar, before this whole dump, was at where? 150, right? Not even its all-time 3-year high. It was just at 150. If we gain $25 back on Caterpillar, we would be at 27% gain. We would be trailing the market. If we just gain back half of where Caterpillar was, we would be at 27% gain, right? So the next stock on our list here is Caterpillar, right? Now let's say that this is it. This is all you want to do. You want to do Caterpillar and Disney, okay? It's going to cost you $90 to buy a share of Caterpillar. I'm going to put that on the list really quickly. And it's going to cost you $90 to buy a share of Disney. I didn't pick $90. That's just a coincidence, right? So let's say they're both trading at $90. $90 at $90. Fantastic. We have Caterpillar and Disney trading at $90. Now, we're going to figure out how we're going to make money with 25 million and with 25,000. Well, you might be saying, Reda, okay, I know that this makes sense to purchase here, but what if I buy at the wrong time? What if I buy and tomorrow we go another 10% down and then the next day another 10% down? Well, let's refer back to what we said about Warren Buffett earlier, and let's not be stupid here, okay? What Warren Buffett's idea of dividing up your money exists because of the percentage swings in SPY on a 10-year average, 8%. If we're moving 8% in a single day, today we move down 10%. If we're moving down 10% in a single day, that means you can play that same idea, right? That same idea in a volatile market over a shorter period of time, right? This is the beauty. This is the beauty with finance and math in general, is if we have, for example, $25 million, right? If we have $25 million, and let's say we think the coronavirus thing is going to last for a whole year, okay? Let's say we think this whole thing is going to last for a year. $25 million, 25 million, 6 zeros, $25 million divided by, let's say we want to buy 1 share of Caterpillar and 1 share of Cat at a day. So it's going to cost us $80, $180, I'm sorry. We're going to have a combined total of 100 and almost 40,000 shares, right? So we'll say 70,000 shares of Caterpillar and 70,000 shares of Disney, right? So if we're buying 140,000 shares, right, 140,000 shares, this is without a hedge. I will speak on a hedge later. This is just a mathematical hedge. This is the beauty of simple mathematics, right? $140,000 divided by, let's say every single week you want to buy something, and let's say you thought this whole thing was going to take, I mean, even if we said a year, right? If we said a whole year, 140,000 divided by a whole year, 52 weeks, right? You're going to be able to buy roughly 500 shares per day. So if you start buying 500 shares per day now, right? Between now and the end of a year, you're going to have $140,000. Right, you're gonna have $140,000 inside of Disney and Caterpillar, and because some entries are good and some entries at bad, but you purchased at a relative low, assuming Disney goes back to even half of where we were, right? You're looking at a combined average that will most definitely beat the 8% average on the year, right? So if we're talking 10%, you're going to 10% on 25 million is $2.5 million. I just want to mention that, right? But you're looking more in the range of something like 20%. You're talking about making $5 million on $25 million in just a little bit over a year. Let's say this thing even takes 5 years, right? $5 million is insane. And if in 5 years we go back to where we were, you're not looking at a 20% gain anymore. You're looking at a 50% gain, right? And this is the beauty of value investing and investing in general. Most people try to figure out this crazy game, this crazy idea. You just have to wait for the right opportunity, divide your cash up, and you might be right sometimes, you might be wrong sometimes, but overall in the end, we know one thing for sure, and that is the stock market is going up. So if we know that for a fact, over the course of 10 years, 20 years, we're going to be higher than we are today, then the idea becomes, how can we capitalize the most on that upward trajectory? And that is just by finding opportunities like this and then utilizing them to the best of our ability, right? Now, you might be saying, right, with $25,000, I can't buy anywhere. I can do anything, right? Because it's nowhere near 25 million. I can't buy enough shares. $25,000, right? This is $25,000 divided by that original 180 is giving us 140 total shares, right? So 70 shares of Disney, 70 shares of Caterpillar. That means, we'll just do it like this, 140 divided by 140 divided by 52. I think I made it 140 divided by 52. You're able to buy roughly 3 shares. We'll say you can even round down 2 shares a day, right? Over the next year, right? You're able to buy 2 shares. I'm sorry. I think I made a mistake. 140 divided by 52. Yeah, I'm sorry. 3 shares a week, let's say, right? So every other day, you're buying a share of, so you start on Monday. Monday you buy a share, and then Wednesday you buy a share, Friday you buy a share, all the way until the end of the year, right? You're doing 3 shares a day. 3 shares every other day. By the end of the year, you've got 140 shares of Disney. Let's say your average, I would guesstimate here, but let's say as you're doing this, Disney ends up running and your average is like, I don't know. Let's say you have a varying every 10%, like a 115 average, okay? 115 average. And Disney, remember, $60, 30 plus where we are right now is already $120. So you're already green if we made half of this move, right? Over the course of the next year. But, as time moves on, you can move your adjustments and play with your prices, but you're already green $5 per share, right? So you're already up about $600, right? You're already up about $600, which might not seem like much, but at the end of the day, you're I don't like to say the word guaranteed money, right? But you're investing over time. And if with this little shares, let's say over the course of a year, instead of making half of its move, it makes a 75% move, right? Which is, my idea is based on the fact that we know we're going to be higher than where we are today. And let's say you had a $115 average over the course of the year, and then we end up back at 150. That's assuming we end up back at 150, right? So at a 115 average, right? At a 115 average, you're looking at $35 per share. So if we do 35 divided by 115, that's 30%, guys. Right? 30%, assuming we move back up to where we were, right? 30%. 30%. So 10% of 25,000, right? 10% of 25,000 is 2,500. Right? So you're going to make 7.5K, right? $7,500 on 25 grand, which is ridiculous. Ridiculous. Those kind of returns don't exist anywhere else, and they're safe returns, right? We're not buying crazy options. We're not doing anything wild. But remember yesterday's video on credit spreads is even if I'm taking a credit spread or a debit spread and I divide my money into lots of 10 and I take 1 month out debit spreads, I only have to be right. Let's say we take 1 month out debit spreads with a 1-to-3 win ratio. Right? So every time we win, we make 300%. Every time we lose that 1, right? And we divide our money into 10, and we buy over the next 10 months. All we have to do is be right 3 times. 3 times. And we would, 30, 60, 90. Yeah, so the 4th time that we're correct, our money, we have made 20%. This is ridiculous, right? This is ridiculous. So even with $250, $1,000, $25,000, $25 million, $25 billion, the same exact concept still exists. Although even if you're using derivatives or if you're using equity like Disney and Caterpillar, and that's not even mentioning how you can hedge against it with, because Disney and Caterpillar both pay a dividend. You can hedge against the dividend. You can use the derivatives to hedge against that stock, and then instead of making 30%, you're making 40%, right? This whole idea is incredibly basic, but this is the only way to take advantage, or the best way, I should say, the safest way to take advantage of this opportunity, whether it be derivatives such as options, or just straight up equity. Right? This is the most basic way to take advantage of an opportunity like this. And it's a way known as value investing that has existed for hundreds of years, and it's made thousands. It may be thousands of 100+ millionaires, right? I hope you guys enjoyed this video. I know there was a lot of passion, right? Because this is the moments I live for in finance, right? But I hope you enjoyed this video. I hope you are able to come up with a way to take advantage of this opportunity, whether it be the way that I just mentioned, or another way that may exist, right? If you come up with a way to make everyone a millionaire, please leave a comment down below. I would love to join you. Besides that, of course, if there are any questions at all, do not hesitate to leave a comment down below. I try to answer all of them, right? Do not hesitate to leave a comment down below. As you guys know, I do have a Discord room where I usually answer a bit more one-on-one there. If you have any interest at all, that link will always be in the description. I'm glad that you guys chose to spend a few minutes from your day with me, and hopefully we can all come out of this wealthier than we started. Stay tuned for tomorrow's video, which will be on debit spreads. I will see you guys in the next one.